La configuración de los mercados ha cambiado en los últimos años, con los grandes inversionistas enfrentando la insurrección de traders minoristas, impactando tendencias y precios gracias a la tecnología y dispositivos que ponen en la mano de casi cualquiera el poder de influir en precios y tendencias. Presentamos la conferencia magistral Next Generation of Trading and Retail Disruption. Con Sosnoff, el fundador de tastylive, programa sobre los mercados de opciones desde donde empuja la innovación mediante la educación financiera de inversionistas de todos los niveles. Fue trader de piso, negociando títulos en el legendario pitch de la Bolsa de Chicago. Construyó una plataforma vanguardista de trading de opciones llamada Thinkorswim, la cual vendió muy recientemente a Ameritrade. Le damos la más cordial bienvenida al Risk Management and Trading Conference 2024.
Awesome, that was a fun introduction. Thank you guys so much. Well, this is my first time in Mexico City, so thank you for having me. Thanks for just being amazing hosts and everything else. And looking forward to the next 49 minutes and 56 seconds. One last thing, guys. Oh, there you go. Perfect. So far I've been treated very well in this city, and I'm enjoying the couple of days I have to spend here. How's the conference going so far? All good? All right. We're going to, I think at the very end, we'll take a couple of questions, but until then, I'll try to run through this presentation for you. You know, one of the things I do when I give presentations is I like to give lots of takeaways. So my objective tonight is to give you as many takeaways as I can in the next 45 or 50 minutes, and I'm going to cover a lot of different topics. A little bit about my history. I'm going to cover a little bit about trading, but in the second half of the presentation, I'm really going to get into things that I think that need to happen and that hopefully will happen over the course of the next couple of years so that everybody else that's in this room right now can kind of carry the torch for the next generation of retail trading. I mean, I've been at this now on the retail side for 25 years, and I've been at it on the trading side of the business for what is now at this point 44 years, so a long time. So let's just see here. Perfect. So just a little bit about my background, because some of you know me and some of you might not. I started right out of college on the floor of the SIBO, and that's the Chicago Board Options Exchange. I ended up actually out of college on Wall Street. I lasted about 6 months, got an opportunity to move to Chicago, and I've never looked back. It's an amazing city, and if anybody ever comes out to Chicago, you want to stop by Tasty and check out the studios or maybe get a tour of the exchange floor, we're happy to accommodate. Anyway, 1981 to 1999, I traded for myself and ran a prop firm in Chicago. So that means that you basically make markets and you trade for your own account. That's essentially what a prop trader does. In today's world, it's much more high frequency and things like that, but I was a pit trader. And the reason I put that background up there is because I want you to know kind of that none of this is like an overnight success. A lot of my history is much of a grind. It's all about longevity. It's all about hanging around as long as you can until certain things go your way. In 1999, the trading pits started to go electronic. And I don't want to say I saw the writing on the wall, but I was for sure nervous that what we were doing and what I love to do wasn't going to be around very much longer. So we built this company called Thinkorswim, which was a fun company. I'm going to get into a little bit about it a little later, but it's an online broker. I'm not sure we knew what we were building in 1999, but it turned out to be a very cool kind of culty online brokerage firm with a very large following that today is now Schwab's main platform, and it routes about 25% of all the retail business in America, which is kind of scary, considering we think we built that kind of on a whim and just, threw a lot of stuff against the wall. We were a public company. We sold it in 2009 to TD Ameritrade in the middle of kind of the economic meltdown, and I stayed on for 2 years, and then I decided I wanted to do something else, and I wanted to build what I thought would be a disruptive financial media company called tastytrade. And I like coming up with kind of crazy, dumb names, and tastytrade was about the craziest name for a financial media company. But the cool thing was we wanted to build a digital financial network that didn't focus on technicals, fundamentals, news, or guess. Nothing traditional. Pure math, pure quant stuff, pure talk. It was a show with a lot of talk about nothing and a lot of math about something. And tastytrade, within 5 or 6 years, became the largest digital network in the world, with viewers from 180, 190 countries and tens of millions of viewers and stuff like that. We were a think tank, basically. We launched a brokerage firm again in 2017. We had a lot of bids for the company in 2021, and so we sold it to a group called IG Group out of London. We are still part of IG Group. We're expanding globally, and I'm still doing what I do at this company, which is innovating, promoting, talking to groups like you, and it's kind of, this is what I do. I don't have any hobbies. This is my life. So I pretty much do this every weekend or try to every other week, and it's really what I love to do, is to get people excited about trading, get them engaged, things like that. So starting off today's discussion on just a very broad thing, because we're all here on a conference about risk, but in order to even have a discussion about risk, we have to find out, why are we here? So I start off with why we trade. And first of all, the main reason when you're kind of here, if everybody in this business, everybody in this room tonight wants to be in this business and wants to excel in this business, one of the things that you need to be able to do to either differentiate yourself or to put yourself in a position to succeed is put yourself, understand your story, be able to articulate why you are different, be able to articulate why you love finance, why finance works for you, and why you're different from somebody else. So one of the things I like to start with is trading gives us an opportunity, because we're taking risk, to make some multiple of risk-free returns. So risk-free returns in the US are, let's say, 5%. So the objective and the reason you're trading is because passive returns might be 3, 4, 5% higher than risk-free returns. And in Mexico, risk-free returns may be 11% or 10%. But obviously, if you're going to take risk, you need to make more than that. So you need to make some multiple of risk-free returns. So when people talk to you about, like, what is the objective, you can put context around why you are trading. You are trading to make some multiple of risk-free returns, because that's what people want to hear. That's what they don't care that you think the market's going to be up 13%, 22%, or 3%, or that you're going to beat some benchmark. They want to know, what is the objective, and using a multiple of risk-free returns is the best way to look at that. Also, by trading, the reason we trade is because it builds our risk skills. We build risk and probabilistic assessment skills. Without understanding how derivatives work, it's very hard to understand things like pot odds. It's very hard to understand the math behind things like expected move. It's very hard to understand where implied volatility works within the scope of trading. Once you start taking risk, and this is a key attribute of risk taking. Once you start taking risk, it grows on itself. And as you begin to take risk, you start to take more and more risk. And you start to take risk in different ways, and you look at things differently. Every part of your life, you'll think of it differently as you start to take risk. And part of that risk taking is being able to assess things probabilistically. So you'll look around and you'll say, okay, this has X% chance, because from a theoretical perspective, we can put a probability number on anything. As long as the markets are efficient, as long as there's a two-sided market. It also, what trading does for us, is it lets us exercise our brains, and it lets us build a skill set that very few people have, which is the speed of decision-making and the effectiveness of decision-making. Very few people in this room are smarter than the other people in this room. Everybody is probably some very close to everybody else in this room when it comes to smarts. The difference is Some people are significantly better and faster at making decisions, which ultimately changes the effectiveness of your decisions. As you go through life, and as you meet lots of people, and as you meet lots of successful people, the one thing that's going to stand out to you when you talk to a lot of people that have experienced lots of success is how fast they make decisions. And surprisingly, the faster you make decisions, the more effective those decisions become. Because you make a lot more good decisions than you make bad decisions, because probabilistically, you've become really good at it. And those are some of the side effects of trading that very few people kind of recognize or put in their back pocket. Sometimes people think trading is just gambling. And the side effects of that are you have negative edge. But I argue very differently. I think that controlling the speed and effectiveness of your decision making, those who process things faster, those who make faster decisions, those are who the best when you think about it, you can use it thinking about athletes. And you think about really amazing athletes. Are they that much more physically gifted than another person? And the answer is probably not. But their brains work differently. They're 2 steps ahead. And that's what happens with the effectiveness of quick decision making. And then we trade because I call this the paradox of efficiency, which essentially means we trade because the markets are efficient. We trade because there is no negative edge. If you trade in a liquid marketplace, there's not negative edge. If you gamble in a liquid marketplace, there's always negative edge. Virtually everything that we do, we buy and sell outside of a listed marketplace, there is negative edge to the counterparty. In the world of trading, we call this the paradox of efficiency because you can essentially do anything you want to do, and you're the strategist with no edge to the counterparty, which means you're on a level playing field, which means you have to learn to think differently, which means we accept the fact that markets are random. We accept the fact that efficient markets rule. And because of that, we can appreciate the efficiency which lets us do whatever it is that we want to do. It's really critical. So why derivatives? Why options? Why, I've been in the option, I ended up in the option business right from the start, so I really didn't have a lot of other choices. But why derivatives today? Why options? And the simple answer to start off with is this: we're talking about capital efficient investing. In today's world, if you want to buy an ETF, an index, whatever they are, they're expensive. The SPY is $550. Different stocks are anywhere from $200 to $300, $400. That means for 100 shares, it's $20,000, $30,000, $50,000, whatever it is. Stocks have become very expensive. This is not 2008 when everything was under $10. This is 2024 when everything is expensive. And because of that, if you believe in efficiency and you understand how derivatives work and you understand how options and futures work, you'll recognize that they're all virtually the same thing. The SPYs are the same as the ES contracts, the same as the option contracts, the underlying stock. Everything works out, everything settles to the same thing. So in the world of where capital efficiency is king, understanding that all these products are virtually the same thing gives you the ability to use less capital to make more decisions, where ultimately what plays out is this massive law of large numbers which lets you make more trades. So the key in 2024 to investing, the key to trading, the key to strategic investing is that it's capital efficient. So we use options and we use futures because they're more capital efficient than stocks. That's why the stock trading business volumes have gone nowhere over the last X number of years, but the options volumes and the futures volumes are exploding. And it's all just about capital efficiency. It's nothing else. Why use $50,000 when you can use $5,000 or $500 or $250 to trade the same underlying? Because success is success. Whether you make 1 penny or 250 pennies or $250 or $2,500, it doesn't really matter. It's all about making money. And if you can do it in a capital efficient manner, you're better off. The other reason why we use derivatives is because they're strategic. Options are not black and white. They are not static. They are dynamic. And that means they have strategy involved. And that means sometimes you're wrong and you still make money. Sometimes you're right and you lose money. Sometimes in periods of really low volatility, you use a certain strategy. In periods of high volatility, you'll use a different strategy. But ultimately, They have tons and tons of strategic combinations that you can use, and you can even assume nothing's going to happen and just bet that the market's going to stay in a narrow trading range, or a stock's going to stay in a narrow trading range. And because of that, we're in this fascinating strategic challenge place. The other thing with it is, in life, it is very important to always challenge yourself intellectually. And there are very few places where you can challenge yourself intellectually. It's hard to find things to create intellectual challenges for yourself or for anybody else. The markets do that. They have these strategy-based instruments, and you have these incredible challenges. They're not all intellectual, but some are. And between the intellectual side, between the emotional side, and between the strategic side, it's a really interesting way to create challenges for yourself, and we all thrive on challenges. The other thing with options, and whether it's futures options or listed options or any kind of derivatives, is that they're essentially, like I mentioned before, they are dynamic, which means they are not black and white. If you buy a stock, it has to go higher. If you sell a stock short, it has to go lower. If you buy a future, it has to go higher. If you sell a future, it has to go lower. If you trade an option, it's very different. If you sell an out-of-the-money call, the underlying can go up and you can still make money. And so we call that dynamic. If you sell something and volatility goes higher, you can lose money just on volatility going higher, the underlying not even moving. So in a world of searching for quick decisions and strategic challenges, something that is dynamic is really interesting as opposed to using something that is static. And if it has a more efficient use of capital, well, then that's cool. So the other thing I love about the derivative space is that as a differentiator, you're engaged in non-traditional finance. And almost every person in this room wants to be engaged in non-traditional finance, because anything that's traditional means it has some legacy behind it that for whatever reason, okay, a lot of people already have their own opinions of. But when you think about a space that's relatively a new frontier, I mean, it's not 20 years old or 30 years old, but as we get into newer and newer technology, we're getting engaged now in what I consider to be non-traditional finance, which is much more strategic, much more derivatives. There is a huge movement. When we first built Thinkorswim in 2000, 1999, 2000, 2001, the amount of option trading on the retail side was 9%. We're now up to almost 70%. At Tasty, we're almost 80%. Just think about that. It's only been 25 years. At Tasty now, we're almost 80% listed options, 20% futures and futures options. This is what I would consider to be non-traditional finance. It's still a minuscule portion of the financial ecosystem, but it's a really interesting piece because it's growing at 15, 20, 25% year over year when the rest of the industry is at a standstill as far as growth goes. So the whole non-traditional side to it, to me, is fascinating. So before I get into kind of some of the changes that I think we need to go through in this industry, I'm just going to give you a little backstory because I think it's interesting and it puts things in context. I'm a person that loves context, which means I like storytellers and I like people that put context around their lives and, you know, why am I up here? So when I started out in this business, I didn't, obviously, when anybody starts out in any business, you really don't know anything. Why the market making part of my career was so important to me, and this is the thing I think that people, they discount too much, is it really takes a lot of time to build like a database in your head. It really takes a lot of time to build the know-how required to be successful, to build the know-how required to get you from point A to point B. It is really hard to be any kind of an overnight success in anything that you do. What you really want to be successful over decades with companies and whatever, it's all about longevity. And what the market making part of my life did is it taught me a lot of things about not just markets, but it taught me a lot of things about, you know, surviving. And basically, we ate what we killed, and that was about it when you work for yourself. And so I think that 20 years of just learning the business put us in a position where we could go out and build a company like Thinkorswim, which for me was a 10-year journey. And it was a 10-year journey from kind of like, hey, I turned to one of my buddies and said, I got this crazy idea. We're going to leave the trading floor. We're going to take all the money we saved up over the last 20 years, and we're going to build this crazy company called Thinkorswim, and that nobody will have any idea what we're doing, neither will we, and we're not going to tell our families. That's true. And so we went out and we built this company from scratch, and we really didn't know anything about technology. But the reason I wanted to put this up here was Thinkorswim was a technology-first platform. The goal, the original objective behind Thinkorswim was, let's build technology that will change the world of option trading, that will change the world of derivatives, and that will engage people through a different kind of attitude, culture, platform, whatever you want to call it. And amazingly, that platform is still one of the biggest platforms in the world today, which hasn't even been changed virtually at all. We threw a lot of stuff against the wall in 1999, 2000, and 2001, 2002, building that platform. But what's fascinating about it is that it's been sticky for about 2 decades. And what we learned in the process of building that platform was that, yes, you can build really cool technology if you kind of take some risks that other people weren't willing to take, and you can go after a market share that had not been exploited. One of the things I like to tell people about building businesses, if you're an entrepreneur or whatever, is don't try to solve a problem. Like a lot of people will say, if you want to build something, figure out what's missing, figure out where there's a problem, and go try to solve the problem. I don't like that advice. It doesn't make any sense to me. Don't try to solve any problem. Go out, if you think you have really strong know-how in something and you really believe that you can create something, go create it. And don't worry about what else is out there. There were 10 different online brokerage firms when we built Thinkorswim, and we put about 3 of them, 4 of them out of business. And we never worried once about those other firms. So don't focus on what other people do. Just focus on your own your own journey, your own ideas, whatever it is that you want to build. But Thinkorswim was basically a technology platform. And in the process of building the technology platform, we also did something else, which was commoditize the fee structure in online trading. We were the first company to offer basically free closing trades. We lowered all the prices of derivative tradings, futures and stocks and options and everything else. So what we did is we created this demand through lowering prices and building really cool technology. But in the process of that, when we were bought out late in 2009, we started to think about what did we miss? Because we missed something. And I came up with this idea that content, as much as I love to do webinars and seminars, as much as I love to go on the road and do money shows or events like this or whatever else it was, or our own events, what was missing in the world of finance was somebody that told a different story. What was missing in finance was a very different discussion about what finance is. And so the genesis of Tasty Trade was, let's build a digital financial network that focuses on anything but anything traditional. So I didn't like CNBC, I didn't like Bloomberg, I didn't like Reuters, I didn't like any of the traditional media outlets for financial media. So I wanted to build something that was fun, where a couple of people would sit around and we would talk about our lives, we would talk about what we ate for lunch, we would talk about all these crazy things in our lives, our families and everything else. And in between that, we would build a think tank. And in that think tank would be a crazy amount of research done by data scientists, done by PhDs, done by math PhDs, done by finance PhDs, done by crazy smart people, statistical geniuses, math geniuses, what you name it. I tried to hire the smartest people, stick them in a room basically, and say, create as much content as we can create, but it all has to be mathematical. It all has to be quantitative. It all has to tie back in to strategic trading. And let's hope that there's a market out there for that. That was the genesis behind Tasty. That was 2011. And originally it was just going to be a talk only, no video. And what we realized in 2011, because this is before there was podcasts, this is before there was anybody was doing anything with video. And we were not exactly built for video. In HD is not my thing. So we built this network and it caught on fire just because we were covering topics that people had never heard before. We were covering things like, crazy breaking down a Black-Scholes model, breaking down an implied volatility model, breaking down expected move, talking about strategies as they related to the math behind it, setting up our strategies based on the math. And what happened was there was just this huge audience, and about 6 years later, we decided to launch another brokerage firm, which today is tastytrade, and the network is called tastylive. We just messed around with some of the names. But the interesting thing about that journey is that was also a 10-year journey. There's a guy in Chicago, his name was Theo Epstein. He was the general manager of the Cubs, and he won a World Series with that's baseball. He won a World Series with Boston Red Sox. He won a World Series with the Cubs, and each team he stayed with for exactly 10 years. And he used to say, my lifespan in a certain company, before something happens, about 10 years. Well, the funny thing is, for me, it kind of worked out the same way. 10 years at Thinkorswim, and then it's been 10 years before we sold Tasty. And what's interesting about that is that people kind of look at you when you build a company and they say, oh, half the people rooting for you to fail, the other half, not even paying attention. And then all of a sudden, at some point, you take enough business and then they say, oh, well, then we're going to try to buy you. So the Tasty journey was 10 years too, and we're still doing it now, trying to expand globally. But I give you the backstory because I didn't start Tastytrade till I was in my 50s. I didn't start Thinkorswim till I was in my 40s. So, I hope that's encouraging for some people that say, oh, you know what, this is, I still have a lot of time left. I still can do things. I still can build stuff. And I think that's a really important message to send, because everybody thinks you got to be 22 years old to roll the dice and start a company. And that's not the case at all. We rolled the dice in our 40s to build Thinkorswim. We rolled the dice in our 50s to build Tasty. And that's just a good thing to know. So this is the part of the discussion where I'm going to go off in a slightly different direction, because I kind of feel like this is something that not too many people talk about, and it's kind of a taboo subject. But on the other hand, after being in Mexico for 2 days now and talking to a lot of people about some of the limitations, some of the regulatory fences, some of the problems with growing the business, growing trading business here and other things like that, I think this discussion is really important. So, first thing, we need to reduce regulatory animosity. And the reason for that is because the regulators, and this is the United States, this is the UK, this is Singapore, this is probably Mexico, I just don't know the regulators here that much, but this is at every regulatory body, including India, including Australia, including Japan, everywhere in the world. There is this tension, there is this animosity between regulators and the people that bring the technology to the marketplace. It doesn't make any sense to me. Everybody should work at least in a collaborative fashion so that the regulators understand what the brokerage firms are doing, so that the regulators understand what the exchanges are doing, and it makes no sense to hire people where their sole purpose is to figure out how to find the firms that are trying to bring technology to the customers. And that's the environment we are globally right now. It's not just the US, it's not just here, it's almost everywhere. And that has to change. In order for this business, because remember what the title of this whole thing is, what does the next generation look like of trading? And in order for this business to grow, in order for us to go to another level, we have got to at least reduce a little bit the regulatory animosity, all those fences, all those hurdles, and make it into something more collaborative. We also need to make the necessary rule changes to encourage broader participation. That means we have to eliminate the hurdles of the barriers to entry for people to take risk. The idea that you need to have a certain amount of money to do something, the idea that you need to have a certain level of understanding before you can do something makes no sense to me. The way to learn is a combination of through doing and through failure. And limiting people from doing and limiting people from having failures really makes no sense in the big picture. So we need to make regulatory rule changes. And this is not just in the US, this is not just here in Mexico, this is everywhere. But we need to make the necessary rule changes to encourage broader participation. In the US, we have crazy things like pattern day trading rules, which make absolutely no sense. We have requirements at some firms that say you can't do this strategy or you can't trade this product without a certain amount of money. You have the same issues here in Mexico. It doesn't make any sense. We should be encouraging participation in financial markets because that is the true way to build some version of financial literacy, and that is the true way to ultimately build up your markets. If you have liquid markets, the entire economy rolls behind them because you create this pool, this exit pool, which then attracts investment dollars. You can't attract investment dollars to an economy without a way for those investment dollars to exit that economy. And until there's a liquid marketplace, that can't happen. So that's why we need broader participation, because with broader participation comes marketplace efficiency. With marketplace efficiency comes this whole cycle of advancement in the economy. Really investment, and then ultimately comes down to the success of the economy. We need to make digital assets part of the portfolio ecosystem. In the US, we have regulatory bodies that don't believe in crypto. They don't believe in digital assets. We have struggled with regulators. We've struggled with fines. We've struggled with products. We struggle on a global level. We don't have, at this point, we still, just think about it, we barely have any finance participation in blockchain. We have virtually zero tokenization. All the technology, I mean, really, what digital assets are and what cryptocurrencies are, it's an advanced technology. And our ability to tokenize, why shouldn't we be able to tokenize different securities? Why shouldn't we be able to tokenize different commodities? Why shouldn't we be able to tokenize various assets? Then they can be traded globally with a single click in any currency you want. Because your currency translates into, or transitions into digital assets. Digital assets mean instant execution. And then everything can be cleared on the blockchain. You don't have to worry about, there's no cost for data, there's no cost for clearing, and all of a sudden, what we've done is we've given instant participation to the entire world, to virtually any product. Why doesn't that happen considering the technology exists today? Like, at least, even if that is too forward a thought, why aren't we in the process of pushing that forward? And why aren't more people talking about that? The idea that we haven't made the progress that we need to make, and it's all being held up because of regulatory concerns. I don't want the regulators protecting me. I want the regulators collaborating and supporting us. We need to have borderless customer access. I cannot come to Mexico and solicit you to open an account with us because we're not licensed here. And for you to come to the US, there's a lot of other issues, which include, currency conversions, and you get killed on both sides going back and forth with multinational banks, and the currency conversions, and then just the money movement and everything else. We don't have anything close to borderless customer access. I understand that everybody wants to protect these pools of liquidity inside of their own native currencies, but the reality of it is either fix your broken market structure or open up access to different marketplaces for do-it-yourself investors, for retail investors, for self-directed investors, for prop traders, for hedge funds, for institutional investors, and everybody else. Either make it open for everybody, or not even, but we should make it open for everybody. And in order to do that, we really need to create this borderless mentality. We're a long way away from that, but it's just another thing that we should have on everybody's radar right now, because it's too damn hard to do business in places outside of your own specific domain. And that's one of the reasons I came down here. I came down to Mexico the last 2 days because I wanted to learn about the markets here. I wanted to learn about Latin America. I wanted to learn about South America. We have customers from all these countries, but they trickle in. And what I really want to do is explode this whole region, because I think there's an incredible amount of demand, But there's so many fences, restrictions, hurdles, and limitations. It's really hard to do. So exchanges, and there were a couple of, the CME was here yesterday, I'm sure there's some other exchanges. Exchanges need to share the wealth. One of the things that drives me crazy, and really in this business, and I rant about this all the time, is exchanges, they charge a lot of money, exchange fees, and they charge a lot of money for data. Yet, they don't contribute to the marketing of the business. They don't contribute to making the regulatory changes, and they don't contribute to the technology ecosystem on the customer side. So what happens is, it's all a money grab. Since all the exchanges are essentially public companies, what happens is they've gone after all the money, they've gotten really greedy about it, and the cost gets passed down to the consumer. The cost gets passed down to the self-directed investor. I mean, if you're routing an order to exchange, why should you pay them for data? Just think about that. That's their marketing is giving you quotes so that you can trade their products, so that you pay exchange fees. Why are you also paying for data? So you're paying them so that they can charge you more for exchange fees, which are also too expensive because in the futures world, there's no fungibility. Troy, speaking just before me, said there's 18 different option exchanges. That's great because the fact that there's 18 different option exchanges means there's this real competition, which is why options have become, why the growth in options has exploded, because there's so much competition that exchange fees are super low because there's 18 different exchanges competing for an order. In the futures world, there's essentially one exchange for one product, another exchange for another product, so there's no fungibility. In the option world, everything's fungible. In the stock world, everything's fungible. So the fees are much lower. It's time that the exchanges stepped up. It's time that the exchanges, and more people need to talk about this, it's time that the exchanges shared in the marketing. I mean, like, just as an example, Tasty, I'm on the road every other weekend and I'm marketing, essentially, I'm promoting this industry. I'm promoting our business, of course, but I'm promoting the industry. I'm promoting trading options. I'm promoting trading futures. I'm promoting getting involved in investing. I'm promoting talking about self-directed investing, talking about returns, talking about building wealth, talking about entrepreneurship, all talking about this massive financial ecosystem, and the exchanges say, thank you very much. We'll send you a t-shirt. It shouldn't work that way. Everybody should be contributing, exchanges and everybody else. We need to elect politicians and enact policies that support trading. There are way too many politicians all around the world, and we vote them into office. Now listen, of course, we are not going to elect some complete idiot just because they support trading. But there definitely needs to be a movement, and this is why I am so I shouldn't even say supportive. This is why I am so passionate about politicians being able to trade. In the US right now, they have this movement. It's a bipartisan movement where they don't want politicians to trade. And because they think that they're trading off of material, non-public information because they know stuff that somebody else doesn't know. The reality is that politicians don't know anything. And the reality is that their track record is significantly worse, regardless of who they are, than the general public. But if people in Congress, if people in the Senate, and if this happened in Parliament in the UK or anywhere else in the world, if politicians traded, they would have respect for the industry. If politicians traded, they would understand what individual investors go through to make money, to build wealth, to learn all these tools, and they would enact the right legislation and they would have the right people run the right regulatory agencies. But because we're all so paranoid that somebody might make a few extra dollars because they had some inkling of some material non-public information, which is complete garbage, and if they did, they should go to jail anyway, we don't elect the right people. And because of that, we have a lot of politicians in place that are not supportive to self-directed investing, that think, oh, you know what, everybody should be a passive investor. They want to take us back 20 or 30 years, which is ridiculous. So it's important to at least know, it's more important to know where people stand socially. It's more important to know where people stand on social issues. We're more important to know where people stand on really important issues. But in the trading side, it's also important to know that we are putting politicians in place, or at least talking to them about things that are important to us in the financial community. And the last part of this segment is Banks need to be better. I don't know how many bankers in the room, so this is not a direct hit, but banks need to be better. We should not go through what we went through in 2022. We should not have situations where risk-free money, okay, is subject to losses and they're essential across the board incompetence. What drives me crazy is when the integrity of all the stuff that everybody in this room, you're busting your butts, you're out here for multiple days, you're listening to a discussion on a Thursday night at 8 o'clock about, finance, and yet we have people all over the world, bankers, that don't understand how the yield curve works, that don't understand what trading is, that couldn't hedge a 10-year note, that couldn't hedge a yield curve position, that couldn't take risk-free money and not screw it up, that basically caused a financial crisis. What the financial crisis does, whether it's 2008, 2009, 2022, or whenever it is, what it does is it destroys the integrity of the stuff that we work so hard to articulate, to disseminate, all the goodwill that we built. Like, I build businesses on goodwill. It's a crazy model. Like, I don't ever charge for anything, and everything we do, we give away. We call that goodwill. And in return for that, we just say, okay, come on and trade with us. That's a fair trade-off. I give you something, you give me something. In the world of banks, and big financial institutions, it's take. Okay, we'll take your money, we'll annuitize your capital that you give to us, because we'll turn it into some form of a long-term annuity where we can make 60 basis points a year, or 50 basis points a year, 40 or 120 basis points a year. And in return for that, we will put all your money at risk because we don't even know how to manage your risk-free money. Because the 50 or 60 basis points that we need to take off the top, we need to take a ridiculous amount of risk to ensure that we get that. So you give us risk-free money, we blow it, and then we destroy the integrity of the industry. And we do that every 10 years, every 6 years, every 8 years, and then we talk about new risk controls and everything else. It's ridiculous. If the people in this room, if the people that manage their own trading account were managing a bank hedge fund or bank fund or bank deposits, they would know, hey, the yield curve has risk. Hey, this is how you hedge a position. It's not that complex. This is not rocket science at any level. This is much more a lot about common sense, street smarts, basic understanding of models, and the implementation of it all in a very consistent, mechanical fashion. This just needed to be said. So, how do we grow the business? Because that's why we're here. How do we grow the business? Well, one thing I said to start off is, everybody in this room, you're all younger than me, you carry the torch. Like, that's what you got to figure out. How do you grow the business? There's a lot of 20-something-year-olds, 30s, 40s, whatever. And part of it is, how do you grow this business? And how do you take it to the next level? Because you're the next generation that needs to figure out, okay, we built the technology, we changed the whole industry. We commoditized the fee structure, we changed the whole industry. We built the content that changed the whole industry. Now you guys figure out the next stuff. Because, I'm still going to be around and doing it as long as I can, but it's incumbent upon everybody here to do that. So how do we grow the business? Well, the easy answer, this is like the standard answer right out of the book, is technology, digitization, and global competition. We have to make this, there's no reason that a firm in Mexico can't compete with a firm in the US. Right now there's plenty of reasons, they're all regulatory, but there's no reason why that can't happen. And if we get into much more of globalization where you can trade anywhere, if we improve the technology so that we can cover multiple markets, if we get into the decentralized space and digitize everything and tokenize everything and at least give people optionality with their money. We have to give people optionality. We can't put people in a box and say, hey, this is a single direction for you. We have to give you optionality. So all of that stuff is important. We need better technology on the front end and better technology on the clearing firm side and on the back end. We push the envelope as much as we can, but in the US right now, the most popular platforms are Thinkorswim, which we built in 1999, Interactive Brokers, which was built in 1990 1997 and 1998. Okay, E-Trade, which was built in like 2002. And Fidelity, which I think was built in the 1950s. We have front-end legacy technology and clearing firm technology that hasn't been updated for decades. Front-end technology needs to be better. The back-end technology needs to be better. Exchange technology, it needs to be better. A little side note, we are building a new exchange right now. It's called the Small Exchange. We're about to launch it. It's a futures exchange, but it focuses on futures options. What we have done to innovate is we have taken a semi-decentralized model and put it into a centralized regulatory model. What that means is we've created the first exchange, and we're launching this in September. We've created the first exchange, late September. We've created the first exchange where you as a customer can be on either side of the market. So you can do whatever it is you want to do in the option world, and if you don't want to, you can take the other side of a random trade from anybody else and get paid to take it. So you can do whatever you want to do and pay a little bit to do it, or you can take the other side of any trade and get paid to take it, but you don't know what you're going to end up with. So we completely leveled the playing field with our new exchange. And we did one other thing that nobody's ever done before. This exchange is a single price, so there's no bid-ask spread. So it's one price. Everything trades at a single price. So what we did is we built an exchange where if you want to buy something or sell something, it's pick a market. You can do whatever you want at theoretical value. There is no two sides. There's no bid-ask differential. Buy something at $1, sell it at $1. And the beauty of that is that as a customer, we have solved for price discovery, and as an exchange, we have solved for market makers. People that don't want to make fair markets, fine, let the customers make markets. I bring this up because I want you to know some of the stuff that we're working on, because this is where your mind needs to be. In the future, this is how you guys need to think. How do you disrupt an entire listed exchange business? Well, we're going to try to do it. I don't know if we'll be successful, but we're going to try to do it. So better technology on the front end and on the clearing firm side. We need to engage people through practical content. The reason I came down to do this particular conference is because this is what this is. This is engagement through practical content. Every single person that's here is supposed to walk away with takeaways for things that they can use, either on the professional side, the institutional side, the high frequency side, the retail side, whatever it is. We need engagement through practical content. What I do every day, our network is 10 and a half hours of content a day. It's about to go to 16 hours a day. 16 hours a day from 1:30 in the morning Central Time to 6 o'clock at night of live content with no guests and no news and no technicals and no fundamentals. Just people talking and talking about finance and talking about trading and talking about strategies and talking about numbers. 16 hours a day. That is engagement through practical content. That is, you sit there, you watch that for an hour, you're like, you're ready, all right, I got to make a trade. That's what it is. That's what I want to see. Practical content. I don't want somebody up here telling me what they think of some giant macro story in Singapore that's going to happen a year from now. It's not actionable. It's not practical. It doesn't matter to me. I don't care if somebody says they have an idea of what they think the Fed's going to do 2 rate cuts from now. Who cares? The bond market's already telling me what the Fed's going to do. That's all that matters. Engagement through practical content, really understanding what moves markets and why. Academia needs to explore markets and trading. Today I visited the trading room at a local university here, and it was really cool that Alan and his group have sponsored. I have done the same thing in Guadalajara at another university. There are trading rooms popping up all over Mexico at different universities. There are trading rooms popping up all over in the United States at different universities. We are finally engaging in curriculum where where professors that understand trading, understand markets, and students who understand trading and understand markets can change this industry. It's really fascinating. We need to reduce the focus on macro analysis because I don't get the importance. I don't really understand it. To me, it's too high level. It doesn't really make me money. You know, I'm okay listening to somebody's macro opinion, but after 5 minutes, I want to move on. I want trading stuff. I want to know how I can apply it. I want to know what's practical for me. Academia is changing. It's slow, but it's changing. It's expensive to change curriculums. It's hard to change curriculums. But we have professors now from all over the world that are watching Tasty, that are using our technology, that are changing the way they think. It's a slow process. It's organic. It needs to move faster. We need to promote product indifference because one of the keys to the future is there's no such thing as a futures trader. There's no such thing as a stock trader. It drives me crazy when somebody says, I'm a crypto trader. What the hell does that mean? Like, I'm an option trader. I've been trading options my whole career, but I just say I'm a trader because I don't care what you trade. Like, if you can trade crypto, then you can trade options. If you can trade crypto, you can trade horses. You know, if you can trade futures, you know, you can trade physical coffee. Like, it doesn't matter. Trade is trade. It's just a question of how efficient are the markets and how many different strategies can you use. But that's the beauty of, you know, product indifference. We always talk about things like, you know, everybody's got this so-called specialty, but it's not even valuable. What's valuable is understanding that you can apply whatever it is that you know in whatever the product group is to any other product, and in the end, they're all the same. They all work the same way. As long as there's some kind of liquidity, as long as they're efficient, they all work the exact same way. So we need to promote, it needs to be universal about product indifference. I don't care what you trade, just trade. We need to aggressively change the approval process for new products. We need to add event-based products all over the world. We need to add binary products all over the world. We need to add things like sports and politics and everything else to the crazy world of just listed securities, because it's really important to continue to engage people through the introduction of new products. That's why crypto was so interesting when it first came out. But so would political betting, but you can't do it in the US. So would sports betting, but you can't do it in the US. So would certain event-based trading, but it hasn't caught on because binary markets and binary options aren't that popular yet. My point is, I'm open to anything to see what works. There's no reason we can't. High-frequency firms can make a market in anything. As long as there's interest, we can have super tight markets in anything. And we need to aggressively expand products and not let the regulators decide, oh my God, you know what? We shouldn't have political betting. It would be super interesting. It would tie in all these crazy political races into a marketplace, which would actually give us real theoreticals. It would be fascinating, the impact that would have on the whole market. We need to appreciate that the true differentiator is content. Content is the king. And if you want to improve know-how, you have to immerse yourself in original, innovative, creative content. You cannot be in a situation where you're reading the same old crap, listening to the same old stories, just a new face. You know, one of the guys on our network, Dylan Radigan, was the first host on Bloomberg. Bloomberg, when they built a news desk right out of college. And Dylan and I have had this funny conversation over the years where he said he had a drawer on his desk in front of the camera with just headlines in it. And they reuse the same headlines over 5 years. It's all just the same crap. They just pull it out. That's not content to me. That's just the regurgitating the same stuff and making it into, and finding a way to eat hours. That's not what content's about. Content's about creativity. Content's about something that's original. Content's about listening to somebody that actually interests you, that engages you, that keeps you, that says, you know what? That's really something I want to do. That's the direction I want to go. So what does content do? It also improves know-how. because there's things like you'll take away from this discussion tonight and you'll say, and you'll use it again. It improves your know-how. It improves your ability to articulate. It improves your ability to improve your own status within the industry, your own opportunities, because you can articulate things that other people that don't look at the content, that aren't innovative, that aren't creative, can't do. And that is the end of my discussion. Thank you so much.